Hey everyone, welcome back to the channel. In today's video, we're diving deep into a topic which is becoming increasingly crucial in today's financial landscape: global investing. Lately we've seen so much volatility in the market. One day it's up, the next it's down. Geopolitical tension, inflation worries, you name it. The uncertainty feels constant. And frankly, this volatility isn't going anywhere. The world is more interconnected than ever, meaning events in one corner of the world can have ripple effects everywhere. These turbulent markets have taught us a vital lesson: the paramount importance of holding a well diversified portfolio. Real wealth isn't built overnight with risky bets. It is nurtured over time through strategic diversification. So, what are the foundational principles of diversification? Well, there are four key pillars: asset diversification, industry diversification, time diversification, and the fourth pillar, the one that we're going to focus on, and the one that is often overlooked in most of our portfolios: geographic diversification. Think about it. Most of us tend to primarily invest in our home country. While that might feel comfortable, it exposes us to significant risk. This is called a home bias. Geographic diversification provides a crucial hedge against single country and single currency risks. If your home country was to experience an economic downturn or its currency was to depreciate, your entire portfolio could be negatively impacted. By investing globally, you are spreading your risk across economies and currencies. But the benefits go far beyond just risk reduction. Geographic diversification also opens door to a world of opportunities that you might be missing out on. You gain access to global giants, the Googles, the Apples, the Amazons of the world. These aren't just American companies anymore. These are truly global enterprises with revenue and operations spanning continents. Furthermore, global investing allows you to tap into companies that are at the forefront of emerging themes. Think about artificial intelligence, renewable energy, electric vehicle, biotechnology. While India is establishing a growing presence in these areas, companies like Nvidia, Tesla, and many more in Europe and Asia are leading the charge in innovation and disruption. You can invest in global leaders in every sector. For example, LVMH for fashion or Pfizer for big pharma. In India, many companies are still in a reactive phase, adapting to the global trends. By investing globally, you can position yourself in companies that are proactively shaping the future. Now, I know what some of y'all might be thinking, and it's a very good question. A lot of people, including myself, consider the US to be an economy that is destined to decline in the long term. Why then should I even consider investing in the US stock market? That's a valid concern, and it brings us to a very crucial understanding of global investing. When you invest in an Indian company, even a top one, your returns are inherently tied to the performance of the Indian economy. It's an Indian company operating within the Indian economic environment. The dynamic is different when investing in a truly global company listed on exchanges like the New York Stock Exchange. Take Amazon or Apple for example. They are headquartered in US and are listed on US exchanges, but their revenue and operations are incredibly diversified. They aren't solely reliant on the American consumer and the American economy. Their success is driven by global demand and their dominance in their respective industries. In essence, when you're investing in these global leaders, you are primarily betting on the strength of their business model, their innovation, their industry leadership, rather than solely betting on the future of the US economy. Also, the New York Stock Exchange is not just home to the American companies, but it is a global marketplace where top tier companies like Alibaba, Tencent from China, top companies from Europe, Africa, and everywhere else are traded. And here's another important advantage, especially for the investors whose base currency is in the US dollar. You can potentially benefit from the appreciation of the US dollar against your local currency. If, for example, US dollar relatively strengthens against the Indian rupee, your investments in US equities will increase in value when converted back to Indian rupee, even if the underlying stock price hasn't increased in dollar terms. So this can provide an additional layer of returns to your global investment strategy. For example, if Nifty 50 and S&P 500 both give 12% year on year annually in the long term, but if you've invested in S&P 500 in US, the dollar appreciates against rupee by 4%. So instead of 12, you're making 16% just because of dollar appreciation. But the US stocks are too expensive. If I just want to buy even just one share, it will cost me like $100 to $200. Well, this is true if you want to buy one whole share. But in US, there is a concept of fractional investing. So you don't necessarily need to buy one whole share like back here in India, but you can buy like a 0.05 share of Tesla and 0.01 share of Apple. So even with a small limited budget, you can easily diversify. So how can you start incorporating global investments in your portfolio? So I personally have been using this app called Vested. I have had a good experience with them, and they are partnered with HDFC. So the fund transfer bit is relatively easy, but these are not my sponsors, so I wouldn't be taking responsibility for these. So do your own research. There's also another app called INDmoney, which I've heard, never used. So there are a couple of options. So please do check them out. Do your own research about the risks and everything, and then make your calculated decision. Before you jump into global investing, there are a few things that you need to consider. So that there could be currency fluctuations, there could be political and economic risks in the country that you're planning to invest in, and research is key. So before putting your money into any company, do your research, study the balance sheets about what theme it is it going to work out in the future. And if you're underconfident about stock picking outside of India, you can even put your money in ETFs, mutual funds, which are theme based, or entire indexes. So that could be a good gateway for you into global investing. Geographic diversification isn't just a buzzword, it is a fundamental strategy to have a resilient, high performing, high growth portfolio. It is becoming more and more important to geographically diversify in these times where every economy, every market is interconnected. By looking beyond our own borders, we are able to access a sea of opportunities and are better equipped to navigate during turbulent markets. What are your thoughts on global investing? Let me know in the comments below. And if you found this video helpful, please like, share, and subscribe for more insightful content. Thanks for watching, and see you in the next one.